Good morning. It's July 30th, 2020. I'm Ken Weber here in New York. Out in Reno, Nevada is my friend and partner, Jack Bowers, Chief Investment Strategist of Weber Asset Management. Jack, we had planned this video a couple of weeks ago or a week ago, and this morning we got some slightly historic news in terms of GDP and unemployment. The numbers were not good, but let's put it into context because I think the numbers were a little bit scarier than they really ought to have been. Just from a mathematical point of view, why don't you give us a heads up on what we should be focusing on in terms of the actual numbers?
Yes, what we are seeing are these numbers that are minus 33%, minus 37%, but those are annualized numbers. So what they're doing there is taking the quarterly decline and then assuming it happens in 4 quarters. So we already know the decline in the second quarter has already been reversed partially by a recovery in the third. So really the actual decline for the quarter was 10%. And when you annualize 10%, you get minus 35% or minus.
Right, and of course, it's highly unlikely we're going to have that same 10%, minus 10% for the next 3 quarters.
Right, and then interestingly, Germany reported their GDP for the quarter, and they don't annualize their numbers, and they reported it at minus 10%. So really, our economy has contracted much like all the other advanced economies have contracted, and we've already seen, you know, pretty much the whole contraction, and now we're on the recovery side. So I don't really, you know, think that the current sell-off based on GDP is all that warranted. I think it's a situation where people just don't know how to do the math right.
Ironically, as you and I were talking earlier, although the S&P and the Dow are down sharply today, it's about 1240 here on Thursday. The NASDAQ actually is up. So a lot of people are taking it, as you said, with a grain of salt, and they can look past today's numbers and the next quarter and the quarter after that. We are expecting some recovery. Same with the jobs numbers was also awful today. You want to speak for a moment about what you see in the job market?
Sure. What we had before is a lot of employees that were furloughed, and we had the government stimulus checks helping people stay at home when they wanted to. And now we're kind of that program is starting to wind down, and at the same time, companies are looking at what their long-term staffing needs are. So some of the temporary furloughs are now becoming permanent layoffs. And at the same time, you have some companies announcing new layoffs and furloughs, and you have other companies hiring. So there's a lot of turmoil underneath the surface. And I think in general, you can assume the employment situation is getting a little worse, just because many small businesses thought this was going to be over in months, and now it's looking like it's, you know, probably a year and maybe 2 before things are fully back to normal. And I think as a result, people are saying, well, if it's going to be a long haul, I'm going to staff for it. And so as a result, you're seeing the present situation where the economy, the economic numbers are looking more grim and the recovery is slowing down. I don't think that's necessarily a concern from a corporate earnings standpoint, because a lot of the companies that are most heavily weighted in the stock market are digital economy players, and some of them are still hiring. And the ones that aren't are largely just staffing for the revenue they have. So the earnings are not taking a really heavy beating here. It's much like after the financial crisis, where, you know, the strong were buying out the weak, and then in the end you had everyone, you know, posting better earnings a few years down the road. I think in the financial crisis, maybe 1 out of 6 companies went bankrupt or got liquidated, if I recall. I don't think this is as bad as that, but it might be half as bad. It's definitely a big adjustment for the economy, but I think the end result is going to be much the same.
Right, and you know, we always caution clients to not look at the headlines. Whatever happens today in terms of jobs or the economy is really not where the market is focused. There might be a reaction immediately, meaning literally within minutes or an hour, or a day or two or three. But generally speaking, the stock market is looking out a quarter or 2 quarters or 3 quarters and trying to get in or out before everybody else.
Maybe even further, just there's some argument that at least tech stocks are pricing for like where 2022 earnings might be. And it's also interesting that the market is largely ignoring present earnings and analyst forecasts because, everybody's kind of clueless. And instead, they're focusing on the future guidance that companies are giving because that gives them kind of perspective for where things might be in 2022. So that all makes sense for the current situation. We're really not going to be able to get back to sharpening the pencil and figuring out earnings numbers, at least for a year, I don't think.
Speaking of headlines, I'm always talking to clients about please ignore the headlines, whether it's jobs numbers that come out and everything fluctuates. Certainly what's on everybody's mind these days is the election. Some people are happy about what might happen. Some people are upset about the election. But the markets do what the markets do, regardless of whether there's a Democrat or Republican in the White House. And same with the Congress. They will have sort of effects around the edges. Jack, why don't you speak, again, we were talking about this earlier, so I know you have some thoughts about how some people are concerned about a Democratic sweep, which may or may not happen, and how that will or will not affect the stock market.
Yes, in normal times, elections move markets. Just, in recent years, we've seen the healthcare stocks move around a lot because of that. But if you're standing on the beach and a hurricane's coming, you don't really worry about whether it's high tide or low tide because there's something much bigger going on. And I think that largely describes the present situation. We may see a Democratic sweep, but I think the market is not going to react much to it, and it's probably already largely priced in. So the idea that we're going to have some big reality check in November that's going to tank the stock market, I really don't see how that's going to happen in a meaningful way. Everybody involved in legislation is kind of the coronavirus is foremost, and dealing with it is foremost, and regardless of who prevails after the election, it's going to be pretty much the same things that have to happen to get things back to normal.
Right. I don't generally like to pat ourselves in the back, nor pat you. You're generally the person who picks all our investments, but I can't let this go much further without saying right now in 2020, as I say, July 30th, all of our model portfolios from conservative to aggressive are ahead of the S&P, which is kind of rare because we have some very conservative models. Can you just talk for a moment about why that happened and what you think will happen in the short term with those numbers?
Yeah, it's a pretty easy explanation, partly because of my view of how tech disruption was going to play out in the economy. We were pretty heavily invested in growth stocks and pretty lightly invested in value stocks at the beginning of the year. And so when the coronavirus pandemic hit, it really kind of accelerated that transition. If you look at how tech disruption might have played out over 5 years, a lot of that happened this year. So it kind of advanced the economy. The economy is more digital now. It's more online now. And a lot of the things that were in the process of happening because of tech disruption just essentially accelerated. So when value stocks tanked and growth stocks rallied strongly, it was a very large divergence, and but we were on the right side of that.
Most of our portfolios are a little bit tech heavy. Is that correct to say that?
Yes, and some of them are very tech heavy. In the long run, I think we're going to have to be more balanced. But right now, the most we have done is trim back the tech position a little bit, just in case we do get a sudden value rotation. Yeah. Much like we did after Y2K. I don't think it'll be quite the shock when it comes because this particular tech surge is more long lasting, and we're not going to see earnings, all of a sudden tank when it's over. A lot of these trends that we're seeing are permanent. There's going to be more cloud computing demand. There's going to be more online conferencing. There's going to be less travel. So we'll get a partial reversal, but it's not going to be, in some ways, we'll be staying in the future when this is all over.
When we started doing these video chats, we were in the middle of the worst of it back in March. We said, you know, it may drop down 50% from its peak, but we said we didn't think that would happen, and that did not happen. I'm still a little nervous short term. You're a little bit more optimistic than I am, but I think just because there's a little bit more nervousness than normal in terms of the coronavirus. But I think we both agree that 6, 12, 18 months down the road, the market will do what the market's going to do based on the normal corporate earning picture. So I think you agree with that, yes?
Yeah. And one way of looking at it, if things are going to be back to normal in 3 years, one way or another. And so I think the market is more or less realizing that and trying to price for it. And the stock market seems less sensitive to things these days because the people who hold stocks now are kind of long-term thinkers. That was not the case before the sell-off. Yeah. But we had a very massive transfer of stock from weak hands to strong hands, and the people who own stocks now know it's going to be 3 years before things are back to normal, and they're just going to wait it out. So there isn't going to be like a lot of panic because all the people who panicked are all in cash.
And that's interesting. You know, there's been a lot written about the people during the pandemic who couldn't go to casinos, who moved to the stock market and are just playing it as if they're in Las Vegas or Atlantic City. And it looks like there's been a washout of that. So that was driving a lot of the short-term action. And I think that has dissipated. Yes, you agree with that?
Yeah. I think day trading saw an increase in interest, and some people felt like their stimulus checks were gambling money, but they couldn't go to the casinos, so they, got interested in stocks. We're also seeing the effect of some of the modern trading platforms too. I know the Robinhood application has become popular among millennials, and you kind of pick your favorite stocks and dollar cost average into them. And that has, had a noticeable impact on some of the tech disruptors stocks in a positive direction as well.
All right, we want to wrap it up today. Jack, I thank you for that. We'll reconvene this at some point in the future. For those of you who are not clients of Weber Asset Management, feel free to get to know us at weberasset.com. On behalf of Jack Bowers, I'm Ken Weber, president of Weber Asset Management. Thank you and have a good day.